So how about a 10% return every year for the next 5? That's the bullish expectation of 25,000 investors surveyed by global investment firm Schroders, which seems unreasonable given the recent rollercoaster ride we've seen on markets. In a world of record low rates, investors are turning to equities for good returns, but there are warnings they may have to temper their expectations. Rachel Pupazzoni has the story.
Angela Thompson began investing in and researching the stock market 18 months ago, and her thirst for knowledge has delivered some solid returns.
Since I've been investing, I think the index that I track has been about a 9% return. So I'm happy with about a 10% return or so, but 20% Australian.
The 39-year-old manages her own investments in exchange-traded funds.
That's a pretty good return.
Interest rates may be headed towards zero, but she isn't alone with her bullish ambitions. A global survey of 25,000 investors found they expect to make a 10.7% return on their investments each year for the next 5 years. In Australia, the goal is slightly higher, while in the Americas, investors are even more ambitious. In Europe, the target is a little lower. But as central banks take the knife to interest rates and the ongoing trade war takes its toll, the survey authors say those kinds of returns aren't necessarily realistic.
In an environment where we've got very difficult global economic conditions, we've got very low interest rates, and we've already had a pretty strong run in many markets. I think that's pretty difficult to see those sorts of numbers being achieved.
As the market recovered from the lows of the global financial crisis, investors have seen some decent returns. The index has increased an average 11% a year since then. But markets are always at risk of volatility. Uncertainty from the US-China trade war, Brexit, Hong Kong, attacks on oil tankers have all seen markets lose billions of dollars in just a few days several times this year. Sudden falls before clawing back the losses. 3 weeks ago, more than $70 billion was wiped off the ASX in just 2 days, at the same time as markets in the UK, the US and Germany all lost more than 3% in the same period. Schroders says historically low inflation and a slowing global economy is not the ideal environment to guarantee the same returns investors have become accustomed to.
Looking at the Australian share market, I think a return over the next 3 to 5 years, which is something like the dividend yield plus maybe some moderate capital growth, so potentially in the order of sort of 5 to 7%.
Philip Muscatello is also hoping for a 10% return, but having invested in the stock market since the 1990s, he's realistic.
It's a bit more of a pie in the sky, having kind of an expectation. OK, 10%, that'd be fine, that'd be a great return, but you've got to look at reality, and the market could just turn tomorrow and it can just bite you.
The biggest investors in equity markets, superannuation funds, delivered an average 7% return for medium growth funds in 2018. The 10-year average is 8.8%. The profession of independent financial advisors says ambitions above those kinds of numbers are at best very hopeful.
We'd all love to get a run of upward bounds with no retracements and no negatives. We all want all return, no risk. But that's not the way that the world works.
Montgomery Investment Management believes an average annual return of 8 to 10% is possible, but not without risk.
Averages tell a lot of lies, and that is that the volatility around that average could be quite high. So some years could be 25 on the positive, or some years could be negative 10 on the negative, but somewhere like 8 and 10 over the medium term. When I say medium term, 5-6 years would be quite reasonable.
Which is squarely where Angela has her sights.
I'm invested for the long term, for sure, so my goal is to buy and hold my investments, not to sell until I retire.
Playing the long game could be the answer to achieving the type of growth she and most investors want.